इस साल के बजट में कैपिटल एक्सपेंडिचर में भारी बढ़ोतरी हुई है। इसके लिए 10 लाख करोड़ का प्रावधान किया गया है। मैं आज देश के प्राइवेट सेक्टर से भी आह्वान करूंगा कि सरकार की तरह ही वो भी अपना इन्वेस्टमेंट बढ़ाएं।
Days after PM Modi's call to action, on March 13th, Confederation of Indian Industry President Sanjiv Bajaj said private sector capital expenditure depended on consistent demand and needed a minimum return on investment. Revealing his outlook for FY24, Bajaj said that apart from ensuring economic growth, the continued increase in public sector Capex would also create new demand. He said this would also help with private sector Capex and provide the tailwinds needed for increased growth in coming years. Bajaj added that in the coming quarters, India was likely to witness a consistent demand curve, which was one of the prerequisites for increased private sector investment. Meanwhile, he said banks were also able and willing to lend now. So, the right triggers for demand growth were all that India Inc. was waiting for. And, according to Bajaj, interest rates were one of the biggest such triggers. In that context, he said that with inflation coming under control, India Inc.'s hope was that the Reserve Bank of India would opt for a pause on rate hikes. Such a move, according to Bajaj, would send a strong signal that it was now India's time to grow. In essence, the CII President has said that a pause in interest rate hikes would spur private investments. But that's easier said than done. While declining marginally from the January print, the retail inflation rate in February still remained above the RBI's upper tolerance limit of 6% for a second consecutive month. As a result, analysts have predicted another rate hike by 25 basis points in the April Monetary Policy Committee meeting. CPI inflation has remained above RBI's tolerance level in 12 of the past 14 months. Crucially, core inflation, the stickiness of which RBI Governor Shaktikanta Das has repeatedly warned about, remained above the 6% mark. Meanwhile, at present, the repo rate is at its highest since February 2019 at 6.5%. Data are also sending mixed signals on the prospects for increasing private sector capex. The manufacturing sector's aggregate level capacity utilization improved to 74% in the second quarter of the current financial year from 72.4% in the previous quarter. Meanwhile, the festival season too could not bring cheer to the economy this financial year, despite being largely COVID-free. Growth in private final consumption expenditure, which reflects demand in the economy, declined to just 2% in the third quarter. This was a sharp dip from 9% in the second quarter and 20% in the first. Data released along with the Q3 GDP numbers show that the post-pandemic pent-up household demand may have fizzled out. Against this backdrop, what do experts think about pausing the rate hike cycle to give private sector capex a boost?
We feel that it may be prudent to pause now and see how the growth and inflation dynamics evolve, rather than go in for another rate hike in April itself. However, the optics of inflation being above 6% may push a majority of the MPC members to vote for a hike in April. Now, in terms of the private sector capex, a pause and some amount of stability on short-term rates may actually help them to go in for faster decisions for capacity expansion.
A pause is certainly needed because the inflation prints that we are seeing has nothing to do with the demand side inflation push. These are because of elevated commodity prices, though they have come down, but they're still elevated, and it is because of external factors. The challenge here is that if we keep raising the rates as a follow-up to the US Fed, then it is going to further crimp private investments. Therefore, the time has come to de-link from the US Fed actions and go for a pause.
Also, are there any other measures that could provide a fillip to private sector capex?
For example, with the recovery that we've seen in airline passenger traffic, we're now seeing very large aircraft orders that are being announced by some specific airlines. So really, consumption has to be very strong for companies to be ready to invest large sums of money.
With the kind of capex allocations that are there, the only way is to move that capex allocation push and actual utilization of the capex allocation so that orders start moving out from the government side. If that front is taken care of, then the segments which are linked to the capex, like say railways, related manufacturing or road related construction activities, that will lead to demand coming from the bottom as well as from the industry.
A number of economists have said that since the current consumption demand is not broad-based, sustaining its recovery would be challenging. However, in a media briefing following the release of GDP data in February, Chief Economic Advisor V. Anantha Nageswaran said high-frequency data showed that consumption remained strong. The Business Standard Morning Show episode dated March 9th indicated the same. Apart from the course of future rate hikes, how the situation develops on this front will also determine how enthusiastic India Inc. will be when it comes to increasing capital expenditure.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.